So my kids watch a lot of YouTube, and I mean a lot. And this isn't really a comment on the future of legacy media, but if what them and their friends do online is representative, it doesn't look great. What it's really an indication of is how immediate the gratification is these days for so many things in our lives. So whether it's infinite 4K content available on YouTube, whether it's something from Amazon, you can probably order, what time is it now? You could probably get it delivered to your house this afternoon if you order it before sort of 1 or 2 p.m. Or not having to wait until you get back from your holidays for your postcards to get to your friends, you just post it on Instagram instantly. So this is happening everywhere in our lives. It has been for a long time. And this quickening of decision making and this requirement for instant gratification is, of course, bleeding over into investing. And so we're trying to ask the question today, are we better to be more active and be more frequent in our decisions, or should we just leave it? Should we just allow our portfolio companies to compound and generate the returns over time? Being patient at the end of the day. So what sort of returns should we expect? Well, this is, on the left-hand side here, 33 years of data. So it's the gross index total returns, large caps and small caps, but the net survivor bias-free returns from the median active large cap and small cap manager. So there's some pretty decent returns available in the market, certainly enough to build most portfolios for most of the goals of your clients, or at least there has been over the past 33 years. That chart to the right, that small cap median active manager chart, is probably the single most relevant reason as to why at Longwave we choose to focus on active small cap investing. And so then the question is, how active do you have to be? How frequent do you have to make decisions? And why are those returns likely to persist? Well, one of the reasons those returns are available for active managers is just the amount of dynamic change in the small cap universe. So in terms of index level turnover, the ASX 300 barely turns over at all, 3% per annum. So if you own a sort of passive ETF, you would have seen this, very low levels of turnover. But even at the index level, the Small Ords is turning over 25% per annum. And that's because there's lots of companies coming in and out of the index and providing lots of opportunities to generate returns. The index itself hasn't done a great job at capturing those, but the median active manager has. So let's have a quick look at that. The far right, that's the range of portfolio turnovers in active small cap funds for the past 5 years. It's pretty wide, so as low as 20%, and there's one fund that turns over their portfolio on average over 5 years, 160% per annum. So very wide range of outcomes. We suspect the closer you get to the top, the more you're getting into very short-term speculation, a bit like, waiting for that Amazon package to arrive this afternoon. If the investment thesis doesn't play out instantly, you've moved on to the next thing. We run about 38% per annum turnover, so not the lowest in the market, but in the bottom quartile. So we're letting the stocks in our portfolio compound and play out and deliver the investment thesis that we think at the beginning of making the investment, that particular company could deliver. But there's only so much each company can deliver to our portfolio. There's only so much expectation for consistency of return that we can put on a company that faces all of the vagaries of market competition, price multiples expanding and contracting. And these are 5 of the stocks that we've held in our portfolio since we began the strategy in 2019. So just over 5 years ago today, we held all of these companies in February 2019. We hold all of these companies today. And while each of them has had a very different path to generating those returns, they're the sort of endpoint returns that have contributed to the portfolio, it's the role that each of those companies plays in the portfolio and the diversification benefits we get that is ultimately the outcome that our investors look for. Let's use some examples here. So CSR is a very cyclical building product company. The market views it as a way of effectively anticipating what the demand cycle will do for building products in Australia. And you can see there the share price in teal moves up and down pretty much with the expansion and contraction in housing demand in Australia. But that's not how we looked at CSR. We looked at CSR as a high quality business in a consolidated industry with high and sustainable returns on capital. And so we didn't think too much about trying to time those market cycles. Macro is not something that we use to try and figure out whether a company is worth investing in. Of course, we understand it's cyclical, but it's over the long term, that compounding of value that matters most to us. And that's just the share price. That doesn't include the dividends. Now, our time holding CSR might come to an end this year. They've been bid for by Saint-Gobain. But that's the way we sort of think about not needing to time macro cycles and focus on the business. Here's another example, Super Retail Group. Super Retail probably looks very similar to what Blake talked about with JB Hi-Fi. So retail's been a very challenging industry for a long time, and competition in retail is brutal. You know, JB Hi-Fi did well because they are exceptional managers. Super Retail Group are the same. So they run those 4 brands at the top there, Supercheap Auto, Rebel, BCF, Macpac, but it's not the categories that they're in that has made them so successful. It's that management execution has been second to none, and they've outperformed all of their competitors in each of those categories to deliver that free cash flow per share growth. Again, very cyclical, very consumer driven, but generating strong long-term returns and has a role in the portfolio. Here are 2 very different stocks that we hold and have held since inception, Hub and Netwealth. And many of you in the room know these companies very well. One person on our table in particular knows Hub24 very well. And they have had a very different journey to a CSR or Super Retail over the past 5 years. It hasn't really been about earnings uncertainty. These businesses have done a fantastic job of growing market share and compounding earnings and taking share away from legacy wealth management platforms. The question has more been around the valuations on these stocks. The near-term PEs have always looked expensive. But as Joel illustrated earlier, high-quality growth businesses tend to grow into and then exceed often very rich valuations that the market focuses on in the short term. And so these companies have over-delivered in terms of their operating performance and delivered strong returns to the portfolio over that 5-year period. But importantly, they've provided this diversification to the portfolio that allows us to hold more cyclical stocks because we have these non-cyclical, stable, compounding growth businesses as well. Let's talk a little bit about reporting season and what we just saw. And this is also why we don't use macro in our thinking of how to construct portfolios and what stocks to buy. If you go back to the middle of last year, the market was obsessed with the risk of a recession. No one wanted to buy retail stocks, and the concern was that earnings were going to collapse, the economy would go into a recession. We don't have a view on that. That's not something that we spend our time looking at. We look at the businesses, speak to the management. What's happened since then is earnings for small cap retailers have gone up. The market got too pessimistic. These are the better quality businesses in the universe, and they've all outperformed in terms of expectations. So macro didn't really help you know what was going to drive those share prices. Just this morning, Myer, of all companies, I mean, I don't know whoever shops at Myer anymore, but in the last 6 weeks, Myer had plus 5% like-for-like growth, right? So the consumer is still out there spending despite calls for them to have collapsed through mortgage stress and other things. Now, if you thought a recession was coming, the one area you probably look for is something with high earnings certainty, like healthcare. These are small cap healthcare service businesses who have this guaranteed demand from the government, but unfortunately, their costs are uncapped. So the wage pressure from nurses and other sources of labour in their business has gone up a lot, and they have no pricing power. They have no way of passing on that cost pressure. So it's flow through to margins, it's flow through to earnings, and with earnings downgrades comes big share price declines. So no 2 charts probably better illustrate why we don't look at macro as a driver of what stocks to hold in our portfolio. We understand it's important, but we don't think it's easy to forecast, and certainly not to the point where you can predict earnings in small cap businesses. So within Longwave, the most important asset we have in generating returns and running our process are the people in the team. But we're humans, and we recognise as humans we have all of these biases. And everyone's seen a table or a visual like this before, and everyone nods and says, oh yes, we have cognitive bias and all these different biases that affect all of us. But actually doing something about it, having a process in place to protect you against your own biases, recognising you have them, and helping to make better quality investment decisions is really hard. It often requires you to do things that are boring, right? To do things that feel like they're a long way from the end investment decision, a bit like this guy, right? He was teaching a kid how to fight. All the kid wanted to do was learn karate, and yet he was doing free home maintenance, waxing cars, painting fences, sanding floors, right? But ultimately, what Mr. Miyagi from the Karate Kid was teaching him was process is all the things you do that lead to the outcome, even if it seems like it's boring and it's not connected. So that to us is what investment process is about, and why controlling biases and going through things like checklists and reading the notes to the accounts are so critical in making better quality investment decisions. And the reason that's important is because of the outcome we're trying to generate for our clients. So the chart on the left, the teal line is the Longwave Small Companies Fund net excess return versus the benchmark, right? So we exist, as Joel said, like Hyperion exists, to deliver excess returns for our clients. But our goal is not to deliver the highest return in any one period. Our goal is to deliver those returns more consistently over time in more different market environments. So a value market, a growth market, resources, industrials, inflation, deflation. We see lots of different market environments, and our role is to try and diversify and deliver performance more consistently through time. That's what really makes Longwave quite different. The concentrated fund you can see there, you can outperform, of course, with a different style. We're not saying that. It's just that our goal is slightly different. The other thing that differentiates Longwave is our fee structure. So we offer a flat, no performance fee small companies fund, but uniquely we also will reduce that fee through time as the funds under management in the A-class unit trust grow to share the benefits of growth with our clients. The world's going to get faster. AI is going to wreak all sorts of changes that we can't anticipate on the world, but we think that the benefits of long-term, patient, high-quality investment decision-making will continue to be required to deliver those returns for your clients. Thank you.